Today, household financial stress in 10 minutes. Hi again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Today I participated in an online seminar and it was focusing in on the question of financial stress in the fast-growing outer suburban areas of our major cities. And there were a number of speakers, and I do recommend that you go see the whole show. I'll put a link below. It's available on YouTube elsewhere. But I want to also play my presentation because in 10 minutes I pretty much gave a rundown from top to bottom of all the major issues relating to financial stress, and in my subsequent answers to some questions that were posed to me, I also talked about some of the broader policy issues. I felt it was worth sharing this because I quite often get the feedback that my live shows are rather long and people don't necessarily see all the way through, but I thought, well, 10 minutes is probably well spent listening to this. Great, thank you very much, and hello to everybody, and thank you for giving me the opportunity to share my thoughts with you. What I've called this is household and financial stress in 10 minutes, and that's a tall challenge, but we're up for it. So what I'm going to do is just quickly go through some key slides about the financial stress, specifically focusing on mortgage stress, and explaining a little bit about where we get our data from, what it's telling us, and then drill down into some relevant postcodes, because the center of gravity with regard to what's happening is right in those high growth areas, and perhaps we can explore some of the reasons why that's the case. So just to take the conversation forward, the first point to make really is that I do a lot of research. We survey households all the time, 52,000 in the sample at any one time. This is primary data. It's right up to the end of August, so it's bang up to date. And one of the critical things we look at is mortgage and financial stress, rental stress, and also even stress amongst property investors as well. It's part of a big research program. If you go to DFA, you can get a lot more about that. But one of the things that's critically important to understand is that mortgage stress is a critical driver of what's happening at the moment for many households, and it's having a direct impact also in house price growth as well. And when we take that and look at house price trajectory in the past, buying and selling intentions and migration statistics and other economic data, we can bang all that into our core market model, and then we can make some predictions about what's happening with regard to home prices. So there is a very strong correlation, not only on cash flow terms for households, but also psychologically and importantly financially, what's happening to house prices ahead. In other words, mortgage stress and house prices are fundamentally linked. And just to show you that, we're going to now look at mortgage stress. So this is measuring cash flow in, money out for households who are borrowing. And essentially, there are about 3-point-something million households who have a mortgage. And at the moment, 40.1% of those households are in mortgage stress. And you can see the yellow line here, which is showing the significant travel over recent times, but a significant jump from February, where it was 32.9%, to 40.1% in August. I'd also make the point that the household debt ratio has been rising steadily as well. Those two things, of course, are related. And my estimation is that because of the cliff, the fiscal cliff ahead, we're going to see that rising even more in September. Now, I can share with you some top-level data. So 40.1% of households, that's 1.5 million households in stress across the country. In percentage terms, by state, Tasmania, then Victoria, then Western Australia lead the way. But in fact, the biggest number is in Victoria. That's, of course, related to the lockdown, then New South Wales, then Queensland. And if you look at it by segment, so this is another way of looking at the same data, by the profile of individual households, young growing families and those on the urban fringe, both battling urban and disadvantaged fringe areas, are extremely highly represented in the surveys. 73% of young growing families, including many first-time buyers, then battling urban and disadvantaged fringe. Note also that exclusive professionals, the top end of the sort of the value chain in terms of income, are also quite well represented in terms of mortgage stress. So this is something which isn't just touching a few segments, it's lots of segments. First-time buyers particularly being hit badly. And I can drill down to individual postcodes. So here's just a few examples. The most stressed postcode at the moment is Ballarat 3350. And then we can look at 6030 and 3029. You can see there 7,000, 6,000, 6,000, 5,000. These are the number of households in those postcodes who are experiencing financial flow issues at the moment with a mortgage. And that, of course, leads to pain later. And we can also look at it by rental stress, just to give you a complete picture. There, 41% of those in rental stress, that's 1.7 million, came out in the survey, 53% in Tasmania, 43% in Victoria, again related to the lockdown, but significant across the country. And by segment, the same story, young growing families, battling urban, disadvantaged fringe. 74% of renters who are young growing families have financial flow pressures. That's a very significant and a very troubling number. And unfortunately, we've seen that growing just like mortgage stress. And interestingly, the distribution of postcodes is a bit different. So Jarvis Bay actually has the largest distribution of rental stress at the moment. But then we've found places like Campbelltown and Liverpool and Gosford and Mount Druitt and Greystanes and places like that in New South Wales, and then down to Victoria like Hoppers Crossing again, 3029. So you'll see these same postcodes coming up again and again. Wollongong is another example, and then Bundaberg up in Queensland. So pretty much wherever you look, rental stress is a problem. And then the third dimension is property investor stress. So why am I talking about that? Because many people who are property investors are potentially going to have to make hard decisions themselves as well. So in fact, we find that 33% of property investors in New South Wales are stressed, and 33.1% in the ACT and Victoria not far behind. And overall, 25% of property investors, or 826,000, are actually now in cash flow issues with their investment property. So unfortunately, whether you're an owner-occupied or a renter or a property investor, things are not looking good. Now, to really make it come bit more powerful, you can look at it by segment again, but here young affluents and exclusive professionals. So the more wealthy people here are actually more exposed to investor stress. And in terms of postcode, Melbourne 3000 is the most highly stressed investor stress postcode, followed by St Kilda, but then Mandurah over in the west and Meadow Springs 6210. I watch Mandurah very closely. That's a bellwether postcode in my view. Stress was building very high over the last 4 or 5 years, and we've now got to the point where home prices have dropped 38% from their peak. And in addition to that, the number of people who are struggling and property investors who are struggling have gone through the roof. And we also see a lot of social issues coming out the back. And the point here is this isn't just a financial discussion. This is a social consequence discussion. And unfortunately, a lot of people, I think, are going to get bruised along the way. Now, if I then drill into the postcodes that you asked me specifically to look at, the first one is 2170, which includes Liverpool. And there we've got 35,000 households, of which 56% of those borrowing are in mortgage stress. 56 is very high as a percentage, higher than the national average of 40. And we've also got 54% of people renting there. So we're seeing considerable pressure in that area. One reason why we're estimating home prices will slide in that particular postcode. And these numbers have been rising quite fast. Another New South Wales postcode is 2567, and that includes Mount Annan and Narran Vale, those places. And there we have 12,000 households in the postcode. 64% of those borrowing are in mortgage stress, and 70% of those living in the area are in rental stress. Extremely worrying numbers there, some of the highest that I see. And again, we are seeing prices falling as a result. So there's a strong correlation between these stress numbers and what's happening to house prices. In Western Australia, 6060 is one I was asked to look at. There, again, 12,000 households, 64% of those in mortgage stress. A smaller number in rental stress, only 35, but the 64% is a very significant number. And prices, of course, have fallen in Western Australia for quite a long time, number of years, but they're still predicted to fall based on our modelling. and we can look across the Victoria 3806, and that includes Huckaway and Berwick. And there we've got 17,000, one of the high growth areas, of course. 90% of homeowners in that postcode, 90% are in mortgage stress, and 60% of those renting are in difficulty. 3029 is another one with Hoppers Crossing and around surrounding areas, another 30,000 households there, of which 66% are actually in in rental stress. Mortgage stress is not too bad, but if you look at it in number terms, it's more than 6,000 households out of 30,000 that are actually in difficulty. So it's still a very significant issue. But this rental stress number in this postcode is, again, very concerning. And once again, we see prices beginning to slide as a result of that ahead. And finally, 3030, which is Point Cook and Werribee, those areas, 36,000 households in and around that area, of which 7,800 are in mortgage stress. That's 40%, so that's a national average number, but it's a large number of individual households. And we also have 5,400 households in rental stress at 37%. So my point is that if you just look at it in percentage terms, it may not tell you the full story, particularly if you have large number of people in the population in the area. So the numbers are important as well as the percentages. And my final slide is this. This is actually a view of Melbourne. And what I've done here is essentially just mapped the distribution of mortgage stress. And the point I want to make is there are hotspots. The area over here, which is to the east of Melbourne, beyond the Dandenongs, is a very significant area, around South Yarra, around there, and up towards the north and the northwest. Pretty much wherever you look, you can see the hotspots. And this is a very powerful way of making, frankly, a very obvious and very critically important point, that mortgage stress is not uniformly spread across geographies. But there is a very high correlation between mortgage stress within a particular postcode and what's gone on there in terms of high volumes of construction, high volumes of growth, high volumes of migration. And quite often in these high growth areas, what we see is a lot of people who are actually up to their eyes in mortgage debt, plus multiple other forms of debt, are struggling with very limited resources to try and manage their way out of it. And unfortunately, they get themselves deeper and deeper into difficulty because they reach for credit card debts or even buy now, pay later debts to try and solve the problem. There is a structural problem in many of these high growth corridors. And unfortunately, because I believe that we're only in the foothills of what's happening with regard to mortgage stress and indeed home price falls, my belief is that this is a crisis that isn't just going to be a few weeks or a few months old, but this is going to be several years. Certainly the experience from both the UK and the US post the global financial crisis was the peak problem hit in year 3 and year 4. And I think you should be planning, therefore, for the long term and not just the short term. So I hope that's given you a quick overview. I've rushed my fences a bit just to get within the time frame, but I hope that has nevertheless been a useful conversation. I'll hand it back. Right, well, I think the first thing we need to do is to raise greater awareness of the concept of mortgage stress or financial stress, right? What I find in my surveys is that the first response when people get into financial difficulty is to hope it'll go away, put their head in the ground and say, she'll be right. That's a very Australian thing to do. The truth is that in the current environment with record low wage growth, probably going negative, very high unemployment, we're going to find more and more people getting into more and more difficulty. And many people have no idea, one, that they're in stress to start with, right? And in fact, I ask that subjective question before we then actually go through and get the information. And basically, there's a mismatch. So there has to be an education awareness lever more than anything else, I think. And I'm not sure that you can leave that to the banks to have that conversation with end customers of the bank, because the banks are always in it for themselves. They're always in it to safeguard their own risk profiles and their own books. So we need to find a way to be able to get that out into the community. I think that's the first point. The second point is we've got to the point in Australia where the debt is unsustainable, because it's not equally spread across all households. We've only got 1/3 of borrowing households amongst all households, and for many of them they've got so much debt that they're going to be struggling with it for generations, frankly. So we need to think of a different policy response, just to continue to say take some more debt, which of course is what the Reserve Bank and what the regulators are actually doing at the moment, and by the way what the bank is doing, and Matthew made the point, it's ticking up. If you're not paying your mortgage back, it's ticking up. We need a different policy response from our regulators and from the government with regards to how you deal with this too high debt, and stop giving more of the same drug when it's the drug that's killing the patient, right? So that's the second point. The third one is there's a very important conversation here about the relationship between rental stress and property investment and mortgage stress and property investment, because everybody's up to this point believed that property is somehow this magic thing that always goes on giving. And in fact, in my surveys, half of the population still believe that property values double every 7 years. We have to get people to understand the reality of owning property or renting property. So I think there's a communication issue here, and you can't leave it to the construction sector who just want to flog more properties, or the real estate sector who just want to do more transactions. There's a missing piece of the puzzle in terms of helping people to understand the reality of renting or owning. So I think these are education issues. I think these are policy levers that central government and indeed, maybe even a local government can get involved in. But ultimately, it's got to be about, firstly, greater awareness, and that's where DFA is trying to help. Yeah, I mean, it is a very important point. The official statistics with regard to unemployment are actually understating the real situation for all sorts of reasons, right? The true rate of under and unemployment together probably means about 1 in 5 households are now facing no income unless they get government support in some way. That's huge. That's a huge change from where we were. And if you look at all the studies around the world, you always go down the escalator when unemployment rises, but you have to climb the stairs to get back out of it again. And that can take 3 to 5 years. And in fact, the Reserve Bank is now saying the official number will probably be 10% unemployed by the end of this year and 7% 2 years later, right? So these are huge structural issues. And I'd also make the point that whilst originally a lot of the unemployment was from casuals and part-time and, bitty jobs, we're now seeing what I call structural unemployment. So we're suddenly seeing mainstream jobs disappearing from the finance sector, from consulting, and therefore this is a much broader issue than many people think. And I actually think the government is not doing anybody any favours by trying to talk it down and say, well, it's all about jobs, right? There's a much more fundamental issue here about how do we value people, right? If we only value people when they're working, then I think we have a philosophical issue about what is the value of people. That's the first point. The second point is that the support mechanisms that need to be in place to handle such large volumes of underemployment and unemployment is going to create a huge logistical issue, not just for the next few months, but this is a 3 to 5 year thing, right? And then going back to your earlier point, mortgage stress takes a long time to season. So people will struggle on. They will continue to try and make payments. They'll get into difficulty. They'll refinance. They'll put more on credit cards. It can take 2 or 3 years for the pressures to build and build and build, and then something goes, bang, and they've got to do something. Now, there is no appetite within the finance sector for early watching what's going on, and earlier reaction and being proactive on this, right? They just wait for the problem to have hit. So that's a problem. The second problem is the way a mortgage works is that the borrower takes all the risk effectively, because if they put 20% of equity in, basically they can lose 20% of the equity and they've lost everything and the bank is still fine. I think, going back to Matthew's point, there's got to be a different way of thinking about shared risk, both upside and downside. That would actually put a much stronger discipline on the banks with regard to how they lend and how they think about lending, and that could actually be really beneficial. And then the final point is we have to be understanding that there is a whole cadre of people in their mid-50s and above, right, who still have mortgages and will have mortgages into retirement, who may never get a job again. And I'm very concerned about those particular cohorts because, again, I don't see the programs in place to address that critical element where we have a number of older people who are very capable people, very willing to work, but cannot get back into the workforce. And if you look at all the studies around the world, it's that group that ultimately get pushed out and often end up moving into retirement, not in owning a property, but in rented accommodation without any income, and then have huge problems into old age. That is probably one of the most critical social issues that I'm concerned about at the moment. Well, that's the problem. We've actually had a policy failure over 30 years, I think, to be honest. And the idea of bribing first-time buyers to go and buy home and land packages and give them $55,000, and by the way, home and land packages go up by $55,000, so it's a net sum game, when in fact the whole economy is a bit suspect, I think is concerning. There's 1.2 million spare properties across Australia, 1.2 million. We do not have an undersupply of property, right? So whatever the construction sector says about we need to build more, that's rubbish. We actually need to build better, higher quality, and in the right place at the right time, not just build up thousands and thousands of cheaply constructed, printed properties. In my view, there is a very important question about home ownership, and people want to own property. I understand that. But I think we need to find a different narrative from the one that's being preached by central government at the moment. I'm afraid that this whole bribe process is more about fixing the construction sector rather than helping people really to get into good, affordable housing. Well, there you are. I hope you found that useful. And of course, we'll be covering stress again next month as the data is updated. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.